Is it time for everybody, Liz, to reset our expectations on this year for stocks?
Well, I think the market's done it for us already this year and re-rated a lot of the stocks that were driving those strong returns for the last 18 months. But I do think it's a good time to sit back and admit that this is not a good setup for economically sensitive areas of the market, at least in the near term. And what we're all sitting here wondering is, what's the breaking point, right? So when you look at where oil prices are, we sat back and thought about, all right, at what point do consumers actually hit that demand destruction level? And if we look at the amount that consumers are spending as a percentage of their overall spending on gas and energy, as of the end of January, it was 3.2%. The comfortable level that we can stay at is somewhere in the low fours. If we get above that level, that's usually where it breaks, which means that we have a little bit more room here for energy prices to go up. But if you just take how much gas prices have risen since the end of January until now, we're almost there. We're almost at that 4% level, and this starts to get worrisome. So either we hit a peak and we start to relax from here, or we keep going and it becomes a contraction picture.
So, Josh Brown, I mean, they go on, Evercore does, and say they say a test of 3670. While not our base case, cannot be ruled out. But these targets also suggest that after this pain, you're going to revert back to some sort of gain. Now, you may not be as optimistic as 5,100 once was, but how do you feel about cutting price targets, resetting expectations, forget the targets themselves, but just the idea of resetting our expectations for how we came into the year because of everything that's now going on and the fact that it may persist for some time. And, oh, by the way, we got to worry about the Fed, too, not just Ukraine.
Just the whole concept of moving price targets after the market does what it does. Like, I feel like these people are experts in telling you what just happened. Is that worth anything? I'm not sure.
I know. That's why I say forget the targets.
See what just happened myself.
Exactly why I said forget the targets.
I'm not even referring to the number.
Focus on the idea. Focus on the idea.
Judge, I'm not. I am. I'm not even talking about the specific target. If somebody's like 5,100 or 4,900, it doesn't make a difference. I'm referring, I guess, to this mentality that as markets fall, there's less opportunity, not more. Of course, that's not how it works. Or at least it hasn't in the last 300 years. I'll let you know when that math changes. But this is when strategists should be telling people, okay, actually, the prospect for equity returns on a go-forward basis are increasing because now there's fear, now there's pessimism, now there is positioning where people are getting to the point where maybe they're not long enough, right? That's actually what's taking place. I'm on the show every week for the last 8 weeks saying it's a bear market, it's a bear market. Now you have all the major averages below their 200-day, and worse than that, you have the 200 days or 10-month moving averages flattening out. It's as clear as a bell that we're in a statistical bear market for most stocks. If not for Apple and Microsoft, we'd be in an actual statistical bear market for the indices. But the point is now when you want to start getting pessimistic, we had a 19% sell-off in the NASDAQ, right? 12% of the S&P. Now you want to get pessimistic? It makes no sense to me. So ignore the price targets entirely. The rationale behind the price targets is interesting, but just focus on this idea. The lower the market goes, the more potential upside. It doesn't work the other way around, believe me.
Hey, Steve Weiss, you know it's bad when Tom Lee's putting out a note today that says stocks are, quote, in no man's land. And he's been suggesting that, you know, we may not see a huge amount of downside, but he's been more optimistic than most. Now he says this, no man's land. So even the most bullish, it seems, are capitulating at least somewhat.
Yeah, well, when I was on the show on Friday, you asked me what would it take for me to get more constructive on the market, because I've been extremely negative since before the turn of the year. And I said when people stop being optimistic, but I still think there's too much optimism out there. I think it's so misguided to refer to this as another geopolitical flare-up. In the past, the geopolitical flare-ups have had short-term impacts, very short-term, and it's generally just been related to a spike in crude, which over the following days, if not the next day, have declined back to more normal levels. This is really a global war. This is global economic war. And to Liz's point, I looked at some data today. The average, the median household income in the U.S. was $74,000, and as of the end of January for 2021, whereas the cost inflation, again on a median level to the average household, is $3,000. That puts you at 4%. So that to me is very, very real. And that 4% didn't come over a long-term period where you can adjust. It came as sticker shock. So my biggest concerns continue to be that you see estimates on individual companies continue to decline. We haven't seen enough of those. And the consumer. So the consumer drives it all. They're 70% of the economy. And we've seen the Michigan survey, consumer confidence decline to lowest levels in 10 years. I think you'll see consumer spending decline. So it's hitting everywhere. And right now, we're just not really seeing it. Some of the stocks have reacted, but you take a look at the airlines. I mean, they're getting crushed, only Alaska and Delta hedge. So they'll try and push those price increases on. I don't think they'll do it. I don't think they'll be able to do it, nor will others. So I continue to be negative on the market. Look, I'm not saying short the market here, even though on Friday after the show I got a little more negative into the weekend. What I'm saying is don't buy yet. It's not time to buy yet.
Hold on.